Hi traders, this is Chris from Elite Currency with a video on trade management and basically focusing on how we can keep those losses small and hopefully catch a few that really go for a nice run. Before we do that though, be aware that trading for exchange and global financial markets is considered high risk, may not be suitable for everyone. Please seek the advice of an independent financial advisor for more info on that. This video is for educational and informational purposes only. If you're continuing watching this video, you agree with this disclaimer, plus you're aware of the risk involved when trading. Alright, today of course was the NFP figure, non-farm payroll was pretty good for the dollar, but still, despite the euro dollar downside, a pretty big rally as well. And I was trading it at the London Open today on this 8th of January 2016. Well, I didn't want to trade it right before the NFP, so I had of course the London Open in mind, and it was 6 hours before the NFP anyhow, so plenty of time to take a trade on the lower time frames. What I want to discuss today is about the timing, the trade management, and I entered a trade for several reasons, but those are really not that important today. It's more about trade management, and the reasons why I took the trade are less relevant. I did use the ACU pivot point strategy and some other strategies combined to make those decisions. If you're curious, I took the euro dollar long quickly because there was an up impulse, as you can see here, right? Very good up impulse. Price was at resistance, but I did see after a correction, price continuing to the upside. So you see price making a rally correction, and then I saw this kind of pattern right in here, engulfing twins. So it looked like we could get a continuation. So when I looked at the 15-minute chart, basically, let's see, right in here, I took that right there. You see a good candle bouncing off the long-term moving averages, correction, bounce, right? So that could have been a continuation. And on a 5-minute chart, that looked like this. Sorry about that. You can see right here as well. Impulse, I was hoping for the continuation. Now, the part what I wanted to talk about is the trade management here. You can see candles going sideways. And when it takes too long for a trade to develop, it's getting riskier and riskier to stay in. Because the original premise, the original idea of entering a trade at that point is, of course, that you have a certain analysis that shows that the market should go up or down, and if it doesn't do that, something else is going on, and you have to reevaluate it, and perhaps there's still plenty of reasons to stay in, and that's fine, but perhaps not. Perhaps the situation has changed. It might be good to do some trade management, change the parameters, or even close a trade. We don't want to do that too often. We don't want to mess with the trade every second, but having a systematic, consistent approach to checking that trade is good, so that you don't just, I think, just taking a trade and letting it go, that is an approach, but it's not the best approach. I know that a lot of traders do very well with that, and that's fine. Stick to that if you like it and it works well. If you like a more active approach, then you think that's a bit more pleasant, I think it does have advantages because sometimes you can get rid of nasty losses. Let me explain how I do that. Now, with an upside here, you can see good candle, right? Good second candle, right? Got a good bullish candle. That was my trigger, right? Good follow-through candle. Nothing wrong with that. Well, a bit of wick on the top, but still, it was bullish. Then I see a couple of candles not going my way. Bearish, bearish, bearish. Still, didn't panic. Of course, when you're trading, just starting out, you panic. You see a couple of candles like that. You click it out maybe, and you just, you're out, right? I think too soon. Because the bullish candle, is still dominating that market, I think, and is still basically the primary kind of force here, the 1 hour and the 15-minute chart, right? But that's not going to last forever. I think that when 5 to 6 candles, that's my rule, do not break this high, the trade is in trouble, on average. And when the 6th candle did not break here, I got 1, 2, 3, 4, 5, and this is the 6th. Didn't break that high, and actually was bearish, started to sink again. I closed the trade and took about a 6-pip loss. All right? And now that's something that might seem easy when I talk about it, but for many traders, maybe you too, taking even a 1-pip loss is mentally difficult because a loss is a loss. And I think that's also important to realize that a 6-pip loss is a lot better than my original stop loss, which was all the way down here, right? And that original stop loss could have been, I'm not sure exactly here, it was somewhere around 108.45, and I trail stopped that actually to trade it. I'll talk about that now as well. You can see the original risk roughly around 37 pips, all right? I moved the trail stop to 108.65, and let's take a look why. I was looking at the 50-minute chart primarily, but I used the 5-minute chart. Why? I used this dominant candle right here on the 5-minute chart to trail stop that. So when price was approaching that, all right, I had the stop loss so that I reduced the risk by half. Now that might not seem that great, right? Yeah, I reduced it by half. But if you do that more often, or if I do that more often at least, it just helps with the equity curve. If I lose a full trade or a half a trade, it adds up at the end of the month or even at the end of the week. So I reduced the risk, all right, using that dominant candle, the master candle in a way, if you can call it on a 5-minute chart. Price did bounce up, luckily. Then I saw the weakness on the 50-minute chart, 5-6 candles not breaking that top, and I took a market exit with -6 pips. All right, so I wanted to show you a trade here as well that goes for a loss because this week I showed many trades with wins, and I don't want to give the impression that I'm only taking winning trades. I do like to show winning trades because, like anyone else, winning trades are just a lot more fun. But obviously, I do have losses. That goes without saying. Wanted to show you one of those, small one though, and the reasons why I trade managed it, why I moved the trail stop, and why I'm happy with that small loss in a way. Now I'll show you some other small losses. I won't dive into the details as exhaustive as with the euro dollar. Don't want to bore you too much there, but dollar yen basically took a short right on this candle, and as I said, the reasons are not really relevant here that much because it's about trade management. But kind of took a break here of this trend line amongst other things. There are more factors actually to go into that short, but that doesn't matter. And you can see, was pretty happy with that short, but decided to exit it just because of the moving averages were in upside momentum, and didn't like the bullish bounce there, so decided to exit it. Now, that probably was a good decision, as you can see here, because price going sideways made a spike up, is eventually moving down, but ultimately would have lost that trade if I didn't take it out. So that was a good decision. And the euro dollar too, by the way, right? Because it did sink. So two decisions where I took out the trade. This one was break even, maybe plus a half pip. Would have been a loss otherwise. Pound yen also exited the trade. The trade was in here. Very short, as you can see. Let's zoom into that area there. You can see that actually I did the same thing, took a few pips loss, same bounce, bullish moving averages on this 5-minute chart, and exited that trade. Maybe a bit too little patience in this case, because after it did move down, this could have been a win if I had the patience, but took a few pips loss. So 3 trades here from this morning already, but I also made some wins. But let me show you the break-even trade first. One more. This was a loss actually for about 11 pips on the euro odd. And you can see here too, taking the trade on the momentum, but bailing out when didn't get enough follow through. I'm not saying that always the case, it's always the best, but when I took short trades like this, short-term trades, there was also another factor that played a role. When I saw that other trades were going my way, I let those run, and I let the trades that were not going my way, I was more aggressive on moving the stop losses. Why would I take risk? You know, if I have a portfolio of trades open and I spread the risk nicely among those trades, you got to be careful not to over risk on the entire trade portfolio. If you do take more than one trade, make sure that the total risk, of course, is not exceeding your limit there. I took multiple trades, divided the risk neatly among those trades, and the pound odd and odd USD and the dollar CAD were going my way. The euro dollar, the dollar yen, the pound yen, the euro odd were not going my way. So why risk on those? I moved to break even, moved those trades to reduce the risk. I think makes sense too. Another factor that played a role, by the way. So the euro odd used this candle here, right here, to move the stop loss. It took about 11 pips loss. I should have probably used this master candle here, the bigger one. But anyhow, it didn't go all too far before we got a dip, and then it finally rose. So the market direction pretty good, but some small losses there. And then dollar CAD, I took a break-even trade. Did go my way very long time, but eventually crashed here and hit my break-even. And 2 trades that did make me a lot of pips. Pound odd, I took it right here, as you can see. Trade went right away in my way, as you can see, right away into my favor. Used this big master candle, the one that happened after my entry, right, because I entered here. Used that master candle to lock my stop loss just below it. That reduced the risk significantly. Let me tell you exactly, about 50 pips, and I was only risking a couple of pips. 50 pip less risk, approximately 45 less risk. So that was great. The market moving my way, and up 40, 50 pips here, sometimes 20 again. But with the stop loss here, I was pretty safe all the time. Then the market rallied again and continued higher, and I took my plus 70 pips profit. And I was aiming for 80, but I couldn't hang in there because I had to leave the PC and decided just to take the profit a bit earlier than that. So this is a trade that right away goes my way. Price is accelerating into my direction, up in pips, and I can move it to a good, secure, relatively secure spot, I thought. And then the market making a second push through. It's perfect. You got those pips right away in your pocket, I think. And there's no insecurity about that trade. Eventually, as you can see, when price made the second rally, by the way, up in here, this part, I then even moved the stop even closer to below this fractal and this bottom, locking in some profit instead of locking in a small loss. You see? So I moved it twice. When the price was in my way, in my favor, and I had the master candle. All right? And then the second point was when I got the second breakthrough, and I moved it to the bottom. Last but not least, AudioSD made a short on this trade, went also right away my way, basically using some master candle here. The first time that price made a consolidation here, I moved it to a minus a couple of pips, and then when it continued, I put the stop loss above that consolidation. So basically, step one, reduce the risk above a decent master candle. Step two, when it continues again, if it does continue again, move to break even or lock in some few pips, and then hopefully it will hit the target as well on the second push, which it did on the Aussie. And I made, well, let me check. I forgot by heart, but I think it was plus 50. No, that was my stop loss though. 1 second. Oh, here was the entry. Plus 40. So ultimately, took a lot of trades this morning. I had 3 losses and totaling 20 pips. So let me write that down. 3 losses, minus 20 pips. Right? And that's minus 7 per trade. I had 2 trades that were break even, like a plus 1 or 0 pips. Let's just call it 0. All right, just a bit above 0. And I had 3 winning trades, 2 good winning trades. Excuse me, 2. Thanks. Totaling 110 pips. All right, and that was plus 45. So what does this picture show you? Of course, I made net gain. Well, obviously, plus 90, right? Plus 90 pips. So profit after 7 trades. Now, looking over 7 trades, maybe not a lot of profit, right? About 13 pips per trade. But still, maybe more trades than I normally would take, to be honest. In this case, I just saw a lot of setups that I liked, and I wanted to trade a bit of a basket, more of a basket, and see which ones go and which one not. But still, I think you get the point. My point is that, to show what kind of trade management logic I use, perhaps you might find it interesting. This is how I tackle it. This is what I do and use in many cases. And I find it interesting. And I like that trade management style that, especially on lower time frames, it kind of reduces the risk, but capitalizes on those big moves. And I think that eventually at the end of the day is important. Let the winners be small, let the winners be large, a few of them, and let the losses be small. And this does that because you got a couple of trades with minus 7, but 2 big trades plus 45 on average. And you can see small losses but big wins, and you got that net profit because those wins kind of totally evaporate those losses. So that wraps up this video about trade management. Thank you so much. If you're interested in Admiral Markets webinar, take a look. AdmiralMarkets.com, click on education, and you got a lot of good educational stuff coming up. Also, of course, the MetaTrader 4 Supreme Edition and Admiral Markets Web Trader. You don't need the software, but you can trade